Hello, everyone. This is Dolores Glass from Wright Flood. I'm Communications Manager. I help everyone understand the NFIP 2012 flood reforms. We're going to show just the basics. We want to cover today what we need to know about the Bigger Waters Flood Act, what property owners might do, and what agents might do to help in this process. Of the NFIP 2012 flood reform laws came to effect because the flood reforms have been enacted as of July 6th, 2012, to modify the NFIP to bring it closer to actuarial rates, hoping that the NFIP will start to collect the amount of premium that's required to cover the claims for the properties that are actually covered under the flood program. Agents should be able to explain these changes to the property owners and to their insureds, and also be aware that in addition to the 2012 flood reforms, there will be another additional group of changes that take place also on the same date, October 1, because the NFIP routinely goes through changes every year in both May and October. So when we go through and talk today about the 2012 flood reforms as a result of the Bigger Waters Flood Act, we all should be aware that there's another group of reforms or changes to the plan, the NFIP program, that will also take effect as well, and we don't want to confuse the two. Okay, the NFIP actual aerial rating in the past, when the NFIP started in 1968, they were charged to reduce the flood-related disaster costs to the federal government. And so they offered flood insurance in exchange for floodplain management. So they asked all the communities that were going to join the flood program, the National Flood Insurance Program, to set building codes that would mitigate flood loss and also establish flood maps for their communities. So in the beginning, when the NFIP first went into effect, they offered some exemptions or grandfathering to people who were in the high-risk area. That's the folks that were on the flood zone map in the A as in Apple or V as in Victor flood zones, because those are considered the high-risk properties. So since the very beginning, the NFIP has offered an exemption to high-risk properties that were built before the flood codes went into effect. Now, low to moderate risk properties in the NFIP were given a preferred risk rate. Because they are in the low to moderate risk flood zone, they are paying lower premiums. So getting back to the high-risk properties now that were exempted or grandfathered from the actuarial rate premiums, across the U.S., about 20% of properties in the high-risk flood zones fall into this category where they pay non-actuarial or subsidized insurance premiums. That represents 1.1 million of the 5.5 million of the properties that are actually covered under the NFIP. So currently, with the July 2012 enactment of the Bigger Waters Flood Reform Act, the NFIP has been directed by Congress that they need to start collecting premiums to cover the amount of flood claims. They also were directed to use actuarial principles in determining those rates. They are going to phase out and remove the premium subsidies from the high-risk properties that were built before the flood insurance rate map went into effect. And those subsidies can account for about 40 to 70% of the high-risk pre-firm policy premium. So before we go too far, let's make sure everyone understands terms. So if we're talking about actuarial premiums, which is what the NFIP has now been told by Congress that they have to now collect actuarial premiums. So right now in the NFIP, the properties that are rated after the flood insurance rate map or post-firm in the high-risk A or V zones, and they are rated using elevation figures for that particular structure, those properties are already rated using actuarial premiums or non-subsidized premiums. So actuarial premiums are what we currently are using for post-firm A or V zones when we use those elevation figures. Non-actuarial premiums or subsidized premiums are the premiums that are based on non-flood risk considerations, like when the NFIP made the decision at inception that they were going to give a grandfathering exemption to the pre-firm A or V zones because they were built before the program went into effect. They're in the high-risk zone, but they did not ask them to get elevation certificates. They allowed them an exemption because they were built prior to the flood insurance rate map. And so those are considered subsidized. And because they are subsidized, not based on the risk of the particular structure, but based more on the date of construction, they are considered subsidized, and with the latest law, will be most affected by the reform of their premiums because they are the most subsidized of all of the rates. Examples of the subsidy-type programs the NFIP has put in place in the past would be the pre-firm construction, that's what we're talking about, built before the flood insurance rate map went into effect and located in the high-risk flood zone, A or V. And also another subsidy program the NFIP has just recently enacted is the flood zone map change exemption, the PRP extension, which allows folks who are newly mapped into the high-risk zone when they previously were mapped in the low-risk zone as a result of a map change. That map change occurred October 1 of 2008 or more current. They are allowed a 2-year extension where they get to pay the preferred risk policy rates. So that's another program, a subsidy program that the NFIP put in place in the past that now the new Bigger Water Act is saying we have to reduce these subsidies and get everyone to pay the actuarial rates based on the elevation of their property. And that's, again, only if they're in the high-risk zone, A or V. None of this relates to the preferred risk policies because preferred risk policies, those are properties that are located in the BCX zone. Those are not considered subsidized policies. They get a lower rate, but they get the lower rate because their property is located in the low to moderate risk zones. So in effect, it is a risk-based premium. Their risk is lower, and so their premium is lower. So preferred risk policies are not affected by the Biggert-Waters Flood Reform Act as far as the premium subsidies go. Now, we'll see them affected at some other point based on other changes that the NFIP may put into place, but they are not related to reducing the premium subsidies because the preferred risk policies are not considered subsidized policies. So what's changing as a result of the Biggert-Waters Act? Well, what is changing is that they're going to phase out the subsidies that relate to the high-risk properties that are now rated with non-actuarial rates, not risk-based rates. So the subsidies that are going to be phased out, these would be pre-firm properties in the A or V zone that are non-primary residences. As of January 1, we've already seen that starting to happen. All the non-primary residences, as of January 1, those folks are starting to see a 25% increase each year in their premium until they reach the full risk actuarial rate. We don't know exactly how long it would take, whether it'll take 4 years or longer, but the non-primary residents have already started to see the 25% increase in their premium. Now, starting October 1st, we see two different classes that are going to start to receive that 25% per year increase in their premium, and those would be the business properties. As of October 1, we'll start to see a 25% increase per year until they meet the full risk rating. And the severe repetitive loss properties, as of October 1, will start to have a 25% increase per year until they reach the full risk rate. Severe repetitive loss properties are those where claims are greater than the fair market value of the property, and those along with the business properties, are both going to get increases starting October 1 as a result of the Bigger Waters Law. Properties affected by map changes, we're going to see those also start to have a phasing in of higher premiums. That will start sometime in 2014, and they're going to allow the mapping changes to be phased in at 20% per year over what appears to be a 5-year period. We're not sure if it'll really take 5 years because as the changes get enacted, they start to take place. We'll see how that goes, but that won't start until 2014. But properties affected by map changes will start to have an increase as of 2014 of 20% of the premium per year until they reach the actuarial rates. That's the phasing out of the subsidies that we see happening. Now, in addition to phasing out existing premiums for existing policies, we also see that new policies that will be issued at full risk rates starting October 1. So there won't be any longer pre-firm risk rating. So after the sale or the purchase of a property, when that new policy gets put in place, it will be put in place needing an elevation certificate and will be using the post-firm rates if they're in an A or a V zone. Again, all these changes are related to properties that are in the high risk zone, A to V, A or V zones. They are going to be using the post-firm rates. So after a lapse in insurance coverage, now this is an important one that agents will want to be aware and insureds will want to be aware that should a policyholder find that their policy lapses while they're in the process of going through this phase-in of 25% premium each year, if they suffer a policy lapse, they will then forego the phasing in and will be issued full risk rates. So what that means is that policyholders and agents are going to have to keep a sharp eye when those policies are lapsing. They would lose the phasing in approach that is in place for other existing policies. So another group of new policies that's going to be issued at full risk rates will be those that are substantially damaged and then go through substantial improvement. Substantial damage and substantial improvement is when a property has been damaged more than 50% of their market value and then they're improved. They should then be using the new building codes that are in place if they're in the A or the V zone. And properties that are uninsured as of the law's enactment. And when they get a new policy put in place, they will no longer be given any pre-firm rates. All policies will be rated with elevation certificates and with post-firm rates going forward. So the NFIP has been charged to phase out the non-actuarial rates, and they're going to do that on existing policies, and they're also going to start October 1st doing it on all new policies. Okay. So now let's look at the premium comparisons, non-actuarial versus actuarial. We're going to look at the same building coverage of $200,000, contents coverage of $80,000 using the 2012 rates. The house at the top, moving from left to right, is non-actuarial. The house at the bottom, moving from left to right, is actuarial. Of course, the water line is there, and we see on the left, the house 1 foot above BFE is charged a premium of $2,235 a year, has minimum flood risk because the house is constructed 1 foot above the BFE where the floodwater would run. In the middle, we see that same house at 1 foot below the base flood elevation, and it has significant risk, and it's also charged the $2,235 a year. And then moving to the right at 10 feet above below BFE, it's at significant risk all the way up to the roof line and still paying the same amount of premium, $2,235 a year. That's because it's pre-firm, and it has the pre-firm discount, and it's paying non-actuarial rates. So the rate of premium they're paying is not based on the amount of their risk. Now, moving to the bottom, we see with actuarial rates, that house that's 1 foot above BFE on the left, and is paying $819 a year because it is in the high-risk zone, although it is built above the BFE. So then at 1 foot below BFE, there is a significant risk on this house, and so the premium that is based on the risk for the house goes up to $5,623 a year. And then moving to the right, we see the significant risk on this house that is built 10 feet below BFE and water risk up to the roof line, and their portion of an actuarial premium related to the risk of flooding for that house is $25,000 or more a year. So that gives you an idea how the risk of flooding should equate to the amount of premium. So what do property owners need to do, and what should they know about flood risk? For a property owner needs to understand what the flood risk is specific to their property and understand flood insurance. Flood risk is not covered under your homeowners or commercial properties. An owner of a property should consider buying both building coverage for flood, and they should also separately pay for contents coverage for flood. Those are two separate coverages. They're not related as they were in homeowners coverages. There are 10 questions that you should ask your flood insurance agent. You should fully understand the flood policy, and one of the handouts to today's meeting will also be the 10 questions you should ask your flood insurance agent. But for a property owner to become fully versed in flood insurance, there is a consumer website put out by the NFIP, floodsmart.gov, that has all kinds of information helping a person to determine what their flood risk would be, and then helping them to understand the flood policy that would cover that. An owner should absorb how these flood reforms that were enacted by Congress are going to affect their flood policy. First of all, it's going to strengthen the National Flood Insurance Program so that there will be a flood policy that will help them cover their flood risk. It's going to assign premiums based on their individual building's flood risk, and so that's going to reduce the subsidies for a lot of properties that were paying premiums that were not directly related to their flood risk, and the subsidies will be reduced in the National Flood Insurance Program. As a result, premiums will be increased. And again, these 2012 flood reforms and the change in the premium are related to properties that are in the high risk zone, the A or V zone. So continuing on with what property owners should know, they should review the flood zone maps for their property. If flood zone maps are changing in your area, and they are changing across the country in many municipalities across the country, your municipality and the building code officer is going to have lots more information and will be able to show you where you are on the flood map, which will show you how close your property is to a change to a different risk zone. Also, the flood zone maps will help you to know how to add features to reduce flood loss and to lower your flood premiums. The building code officer in the municipality can give you lots more information, as well as FEMA.gov has information on how to build your property safer and to build it up higher. When new flood maps are enacted, property owners should get to know their flood maps. They should understand that their flood zone and flood risk for their property is different than their neighbors, and call your insurance agent to request a flood insurance quote so that you'll know exactly what your property flood risks are and be able to know how much it will cost to cover your flood risk. Review your flood policy coverage if you have a flood insurance policy. Often when flood maps change, your flood coverage can change, and there are things that you can do to improve your flood coverage based on changes in your flood map. Also, there are mitigation programs that help you lower your flood risk and lower your flood policy premiums, and FEMA has a few programs that you can look up on their website. Now, how will your agent help you? An agent will help to inform policyholders how this phase-in of premium is going to go. We're asking agents to get in touch with their policyholders, to send them a letter that would encourage policyholders to call their agent to discuss changes to their policies. Make sure that agents and insureds should keep an eye on policies that might be expiring. The phased-in approach, increasing premium 25% a year until they reach actuarial, is immediately ended if you let your policy lapse. Also, agents can show policyholders the impact of what the rate comparison might be if there's a loss of subsidies to their property. Again, these are for properties in the A or V high-risk zone. Review policies is what the agent should be doing to help the insured. Existing policies that are in effect can potentially have some policy changes that will allow an insured to continue their coverage and still manage affordability of the flood policy. Again, keep your eye on policies that are reinstated, because after the lapse, they immediately go to the full premium increase rather than the phased-in approach. And when an agent gives insured a quote on flood policy, or when they're modifying an existing flood policy, it's very prudent for an agent to get a signed rejection waiver to protect the agent's E&O. Also, if there are map changes, the agent can help the policyholder to understand the schedule of map changes and also to know where to go to floodsmart.gov to actually look up and keep in touch with the schedule of those map changes. So we've gone over the basics of the NFIP 2012 flood reform laws. Congress has passed them. We understand now different groups will be increasing their premium. Existing policies will have the 25% increase in the next 4 years or so. But new policies starting October 1 will see full actuarial risk-based premiums in place. All premiums will become risk-based as part of the Biggert-Waters Flood Reform Act, and affordability is going to be the next challenge that the NFIP is going to have to address. Owners and agents can take action to understand the flood policy, to understand what their flood risk is, if they have any flood map changes, and more important, to understand how the Biggert-Waters flood reforms are going to affect them. So one of the things we need to remember is that today we're talking about the NFIP flood reform law, but normally in October and also this October 1, the NFIP will be having their annual premium changes. These are two separate type premium increases. One is an increase because of the flood reform law. The other is the normal annual increase that the NFIP puts in place either in May or October once a year. So there will be two increases taking place this October 1. Wright Flood will continue to provide information to both agents and property owners about the upcoming changes to the NFIP, whether they're related to the flood reform law or whether they're related to the normal annual changes that the NFIP program goes on. There's lots more information available both on the Biggert-Waters flood reform law. There's a summary attached to today's presentation, and also there's information on floodsmart.gov to help policyholders understand flooding and understand the flood policy, as well as many resources available on FEMA.gov for flood mitigation. Again, our intention today is to provide some information about the NFIP flood reform law. I hope that I've been able to communicate clearly. If not, all disputed topics will be referred to the NFIP flood manual and the flood insurance policy for further verification. We would like you to visit our website at WrightFlood, www.WrightFlood.com for more information, or if you'd like to find a flood agent, a Wright Flood agent, or to become a Wright Flood agent, please contact Flood Marketing at weareflood.com at that phone number. Anyone who would like permission to use this video or further information about flood insurance issues, please contact me there. Thank you very much for your kind attention. This is Dolores Glass for Wright Flood. Thanks again. Bye now.